Hello, everybody. Stephen Mead here for Domicile Real Estate for people who love houses. This is our Southern California housing market update for June 8th, 2021. Welcome back, everybody. We have a really big episode because the market is changing, and we're going to talk about those changes. And then at the end, I'm going to talk about who the winners and the losers are in this change. So let's get right into our display for this week for our data. Hold on, let me pull it up here. I actually should have had this up ahead of time. Not sure why I closed that window down. But what I will do is I will get that up here. Give me a second. Perfect. So let's jump right into it. I don't really want to waste any time. I think this is pretty important. So coming right back in here, get back to the beginning. All right, number one reason why the market is changing. So you'll remember we talked last week about it was kind of a holiday week, and I think I was a little hesitant to sort of draw some conclusions, but I think we've got some pretty clear data going here. If you look over the past month or so, we've definitely seen a rise in inventory in our under $1 million category, and we've definitely seen a rise in inventory in our $1 to $2 million categories. This is our total active listings, and we have seen these numbers go up. So that's kind of clue number one, that we're kind of in a different period than we were here, right? Like if this is sort of our mid-spring, that February, March, April time period, right? I mean, very, very constant inventory. But look here, as we head into through the month of May, things are absolutely changing and they are different. So part of this is a little bit of springtime, which we're excited about. But part of this really, I think, is kind of a little bit of a shift. So moving on, our new listings, right? If this is our sort of supply side of our equation, right? Now, we do notice we have some reduced new listings the past 2 weeks, right? Which indicates that maybe there's kind of a little bit of a pause in some of the markets. This isn't just the holiday week here. It's way more pronounced in our under 1 million range, but we even see that up here in our $1 to $2 million range as well. Now, of course, what's really important though is to look at the converse demand curve as well and see where is demand at the moment. And if we take a look here, this is really kind of the area that I want to talk about. If you go back to this in terms of our number of new escrows, look at where we are. We are at a point really that we have not been at since back in February. We dropped below 3,000 new escrows under $1 million. It's not quite as drastic in our 1 to 2 million, but even that shows now a 2-week trend, right, of dropping. And I think really that's what's important, is we've got 2 weeks in a row of seeing these numbers decline. So, what we're going to do is we're going to talk about some of this data and sort of how we arrive at conclusions. None of this alone would be a smoking gun. It's really when we take all of this data together that we're able to draw some conclusions, when sort of all the indicators are pointing in a particular direction. Now, just a reminder for everyone out there, this is data that is tabulated for Los Angeles and Orange counties. Because this is a market shift, I don't want to make comments about other market areas, as they could have different results. If we look here at our absorption rate, right, this is our reconciliation of supply and demand. One of the things you notice is that, really this is not an all-time low, but definitely towards the lower end of the range of the spring for our $1 to $2 million category, meaning this market is less competitive. If you look again here, you can see we've had 2 weeks in a row really of declines as well in our under $1 million entry level category. We're still not at kind of a previous low point, but really when I start to see these things go downhill like that, it does make you pause and think a little bit. Now, if we look at our closed prices, I want to give a little bit of a caveat, again, is to remind you that this data is 4 to 6 weeks old. And that is because this is based on homes that closed in the last week, which means these are homes that were negotiated 4 to 6 weeks ago. If we look at that at our upper end, pricing is fairly flat. I mean, really, it hasn't moved a huge amount. If we look here at our median price, prices are up a little bit. And if we look at our entry level, prices are up a little bit more. That really makes sense when you think about what's kind of going on in our market. The entry level is probably the most impacted here. But even when we look at this, we see that we're not having these kind of huge jump weeks. Like if you look back here, there were a couple of weeks where we took pretty sizable jumps. That's not what this looks like here. In fact, this is a fairly smooth, gentle rise. And remember, this is 4 to 6 weeks ago, not this past week. So if we come back here, this is kind of another sign, right, that our market has moved a little bit. So what this is telling us is this says we look at all the homes that just came on the market in the last 2 weeks, right? So these are the freshest listings, right? The ones that just hit the market. And we're looking how many of those are still left? How many today that went on the last 2 weeks could you still go out and write an offer on? And guess what? Both our 1 to 2 million and our under 1 million really have hit highs that we haven't seen since the beginning of the year. And to me, all of this data together, right? It's not just one of these indicators, it's that all of these indicators are kind of pushing in the direction of a market that is a little bit softer. And I think I have an explanation why here that we're going to get to in just a minute. So if we look at our close to list ratio, again, this is based on things that closed in the last week, which means these were negotiated 4 to 6 weeks ago. I don't think that this 104% is really sustainable in the long run. You've seen this just rise through spring of consumers have overbid houses. I think in a couple weeks, we're going to see this start to ease back down, maybe right around this 100%. Just to give you an idea of what is normal in a steady market or a lightly increasing market, normally you see this around 98 to 100%. So normally you'd be in this little quadrant down here of our graph. You would not be up here. So I'm curious what the next couple weeks are going to bring. But here is kind of the real piece of data I think that was surprising. We have had, sort of remarkably steady days on market drops through the spring. I mean, you look back here, beginning of January, for our 1 to 2 million, I mean, we were near the 50-day mark, around the 30-day mark for our under 1 million. And then you just saw these numbers march downward, and it just really, down here, we sort of held at this kind of like 18, 19-day mark. But look what happened is we saw increases in both. Now, we have seen a couple of increases like this before. Most notably, this was right around I think during when interest rates were rising a little bit. We've seen kind of these little jumps before, but something tells me this time is different. To see both price categories moving upward like this, and that days on market statistic moving up 2 days or so, I'm taking notice, especially when I combine that with all of the other data points that we've been seeing. Finally, we get to why I think this is happening. So if you look at our affordability versus 2018, if June of 2018 was 100% and we were to say, where is it today relative to that? We are at around 118, 117%. And guess what? I actually think we're running into a little bit of sort of not affordability wall, but I think the market is kind of taking a pause, saying these increases can't keep going forever. And finally, if we look here at our interest rates, we saw a little bit of a gain week to week. We're still right around that 3% mark. These are still great interest rates. I still believe that anybody who's looking to make a long-term homeownership decision, literally having a 30-year fixed rate mortgage at 3% is money in the bank. I think in the long run, I think anybody who doesn't have a mortgage right now will be kicking themselves 5 years from now. Okay. I ran through the stats pretty quickly because I wanted to take a little bit of time and I wanted to go over who do I think this sort of shift in the market is affecting, right? Who is going to benefit from this and who's going to not benefit from this? So let me start off by talking about the biggest winner in this. And the biggest winner in this is buyers, right? I think a couple reasons why. I think if you're a buyer, now you're in this wonderful position where you have a little bit more choice in terms of what homes you're buying and writing offers on. The market is a little less crazy, and to top it off, you still get 3% interest rates. Really, this is really a win situation for buyers. For sellers, I think sellers are the ones who probably have the least favorable position, right? I think this crazy market has really let a lot of sellers get away with things that in any other kind of market they wouldn't be able to get away with. But I'm going to mention something really quick, and I don't, I'm an optimist type person. That's who I like to be. However, I don't think I'm being overly optimistic when I say this. I actually think that this market is beneficial. This easing is really beneficial for sellers as well. And the reason I say this is we have a very, very high fallout rate on escrows right now. That means you have buyers who will do anything, they will say anything, agree to anything to get an offer accepted. And then they will oftentimes change their minds and use one of their tools to back out of that transaction. I don't really think that's a good deal for sellers, especially sellers who are trying to move up and maybe looking at other houses. So, I want to see where this market goes. But the other reason why I actually think this is very good news for everybody involved is one of the things that we've been talking about in terms of this affordability is that if you've watched our bubble talk video, which you absolutely should, again, we will put a link into the description if you are watching this on YouTube. If you're watching it on Facebook, we will go ahead and put a link in the comments when I finish this. The reason why this is really a good thing is one of the things we've been talking about is that we're not out on some crazy limb of anti-affordability right now at the moment. At current prices and interest rates, median priced home payments, which is how most consumers make decisions, those payments are really in line with sort of historic norms. They are not out there on some crazy precipice of unaffordability. However, if we continue having 5 or 6% months, meaning where home prices increase by 5, 6, 10% in a single month, then we will be in dangerous territory. So to watch the market pull back a little bit at this stage, to me, is very encouraging because it means we're not going to get in some crazy irrational run up where buyers start making very irrational decisions. I think we were right where we should be. And I feel like the market is responding as I would expect it to, that we're going to kind of bump up on a little bit of a soft ceiling here, and that the price growth is going to have to ease, that we can't keep having these double digit, being on pace for a double digit year. I don't think that's sustainable. And I'm glad to see that it looks like, this market is easing just a little bit to sort of take that into account. Anyhow, everybody, thanks for watching. We love doing these videos. We love hearing from you. We love the comments. We love the discussion in the comments. It's always a fun time. Obviously, if you have any need for real estate services in Los Angeles or Orange counties, definitely reach out to us. We would love to work with you. Don't forget to like, subscribe, and hit that notification bell so that you will see all of our videos. Just as a reminder, for watching this on Facebook, we only do Facebook Live for half of our videos. So if you're watching this on our Facebook page, you are only seeing half of the videos that we put out on the market, and then you're missing out entirely on a lot of our other videos. So absolutely take a look at those. Trying to think if there's anything else. Questions, comments, keep them coming. We will see you later on. Friday is our entry-level first-time homebuyer market update where we do our stats geared just towards the entry-level end of the market. So you definitely want to subscribe to our YouTube channel so you can go ahead and see those as well. We'll see you soon, everybody.